Welcome to another episode of Equity Mates. My name is Bryce, and as always, I'm joined by my equity buddy Ren. How's it going?
I'm very good, Bryce. Last episode of the week. Great that we get a short week here on AusBiz, only 4 days. But what a week it's been. I have a whole new appreciation for dividends.
Yeah, true. It's been fascinating. I didn't ever think I'd get as excited about dividends as I have. But look, we are absolutely stoked to have David Keir from Dundas Global Investors back on Equity Mates at AusBiz for the final episode of our week-long conversation. So David, welcome.
Yep, good morning all from Edinburgh.
David, it's been a really enjoyable 3 days, and we're closing out today. We've spoken about your investment approach, how you're finding companies with sustainable dividends, and the importance of finding those companies. 3 great stocks on your watch list yesterday, and today we're just going to have a bit more of a general chat about how you're thinking about markets and a few other, I guess, more controversial asset classes out there. But let's start more broadly. At the start of the week, you briefly mentioned that you've been in markets for 20 odd years. You've seen a lot of the crashes. You've seen it gone through the GFC, and now we've just come out of what feels like coming out of COVID. And here in Australia, we're lucky, well in Sydney anyway, lucky to be experiencing Freedom Day and seeing the light at the end of the tunnel. So how have you navigated the last sort of 12 months, and what's the general sort of feeling been at Dundas?
Yeah, well, it's a fascinating question, and I guess there's two aspects to this. We've got a lot of exposure to sort of the healthcare sector and also technology sector. And if you think about the last 12 months, that's really played to the or not the last 12 months, but really since COVID hit, it's played to the strengths of both of these sectors. Thinking about technology, if you just think about, we're having this conversation online using technology that wouldn't have existed 10, 20 years ago. So a lot of the secular growth drivers in the technology sector have really come to the fore over that period of time, and that's obviously been reflected a lot of what's happened in markets. But from an ability for us as a business to continue to operate, and many businesses continue to operate, it has been the technological developments of the last 10, 20 years that enabled companies to do that. So that's been a tremendous theme that's been playing out. The other, of course, has been the healthcare side. The healthcare in terms of the long-term growth drivers have still been there, but obviously what's been happening the last 12, 18 months has been, continued development of new products, innovative new products. So you have aging populations, sadly rising prevalence of chronic conditions, but what's been really interesting is the development of new medical products and therapies, etc., that is really, really coming to the fore. So in terms of the secular long-term growth drivers of a couple of our favorite holdings, those have never been more evident and never been more pronounced. I guess the other side of that is, are things that are going to reopen. So, we all were stuck in our homes for periods of time, unable to do the basics of perhaps go to some shops, go on holiday. So a lot of these things will open up. We talked a lot about sifting, so we actually had a look at the travel and leisure sector at the end of 2020 as a potential sift, and we did a high-level review. And things will open up, but obviously it's going to be slow. People are talking about corporate travel not rebounding till 2024 in terms of 2019 levels. But what was really interesting to us was the level of debt within the sector. So you look at the cruise companies, for example, they've not been able to sail, but they've continually had to issue equity and debt to get through this, which is good. They've got through it, but perhaps not so great for long-term equity returns. So there's been a lot going on ever since COVID struck, but I guess 2 key themes: the secular growth drivers now more pronounced in healthcare and IT. At the same time, we'll see the reopening trade happen and some interesting businesses coming through that.
Fascinating time, David. And I think beyond COVID, and definitely tied to COVID and reopening, the number one story in 2021, and especially as we get to the end of 2021, has been the question around inflation. And especially in the US, the conversation has been really pronounced about, they're definitely seeing inflation, but is it transitory? Do you have a view on this inflation narrative and what it could mean, especially because you take a global focus with your investments? What's your view on this debate?
Yeah, well, make a few points. if I may. There's a lot of noise. I mean, even just the last 4 or 5 weeks, it's been incredible in terms of the amount of noise out there on the macro front. And you've now obviously interest rates, global interest rates are in certain countries starting to go up, and there's talk about, we're at the end of the stimulus programs will end, and we will see interest rates rise over the next few years. So it has been quite a change in narrative, and you can see that being evidenced in the US 10-year bond yield, and that has gone up from sort of 1.3 to 1.6 in a very short period of time. And as you alluded to in the debate, is inflation transitory or not? If I could address it this way, if I may, at Dundas, we're all about the micro. We tend to try and not get too caught up in the micro. But the way I'm thinking about framing this dividend growth, obviously the whole thesis is if bond yields rise, bond yields become more attractive versus equities. We get all that. But if I just make a quick point on dividend growth. If you remember what we talked about before, we are the dividend growth investors, not dividend yield investors. So for us, we're dividend growth investors that want to see companies reinvest their profits today to ensure tomorrow's growth. So what that means is that the dividend yield on our portfolio is actually lower than both the market and also the US 10-year bond yield. So for example, the yield in our portfolio today is about 1.3%. But the yield on the all companies world index is at 1.7, and as I said, the US 10 years are at 1.6. However, it's all about the dividend growth. So the dividend growth on our portfolio since launch has been over 10% per annum. Over the same period, the growth on the all companies world index has been more like 3%, and clearly bond yields don't pay a rising dividend. So what's really interesting is if you think about the total income over a prolonged period of time. So it takes our portfolio about 5 years to catch up in terms of total income because it's growing at 10% per annum against bond yields, and about 6 or 7 years against the market. But what's really pronounced is after 20 years, the income we'll have received in the fund will be more than double the market and double the bond in the 10 years based on 1.6. And over 30 years, it'll be more than 5 times, so quintuple. So that's the way we try and frame this debate. There's a lot of short-term macro noise. I get the whole debate, is inflation transitory or not? It does feel like it's going to be more long-lasting than perhaps the central bankers had hoped for. And obviously the big thing people are watching for is clearly wage inflation. If that starts to tick up, that's one thing that's difficult to put back in the box. But the way we think about it, it's all about dividend growth and thinking about rolling up this income over the long term, and the power of compounding you've just seen there from the numbers I gave you.
So David, we always like to get an idea of where the consensus sits and how people think about it. Is there anything that you kind of believe the market's getting wrong, or market consensus is getting wrong as we head into the end of the year, taking away the inflation debate?
Yeah, well, I mean, we tend not to be focused very much on things like that. I mean, as I alluded to in an earlier day, we do everything ourselves. So we tend not to really even look at things like, what the market's bothered about. We're much more interested in looking at those 71 names, getting under the bonnet, doing the work ourselves, and making sure these businesses can grow their dividend growth. But I would say a few things. I mean, the market, I guess there's 2 or 3 things the market is focused on. And I think it does come back to the inflationary point, and it does come back to people concerned about peak margins, rising input costs, what's the impact that's going to have. If you have interest rates going up at some point, does that choke off demand? So you move into the stagflationary environment. Another issue people are concerned about is valuation. Markets remain very high despite the recent volatility, and valuations are quite high as well. So we don't compare ourselves to consensus in any way. So it's impossible for me to have a look at that. But I think those are the things that the market is thinking about as we look into next year, particularly probably the margin point, the peak margins plus the rising input costs. And I guess the way we think about it is in terms of it's all about pricing power, and the sort of companies that we are investing in, and the ones we talked about yesterday, these are businesses that have secular tailwinds and have pricing power, and over a period of time will be able to pass on the rising input costs to their customers through increased pricing.
David, you mentioned valuations there, and I'm interested to get your view on how you approach valuations at Dundas. The focus is on sustainable and growing dividends. Do you do you look at valuations? And if you find a company that you think has great growth prospects and has been growing really well, but is overvalued, will you exclude that? Or are you less worried about valuation because the companies you're finding should be able to grow into whatever valuation they're trading at today?
Yeah, no, we absolutely are focused on valuation as well. But the starting point for us, if we think about just breaking down, so the starting point for us is what is the sustainable growth rate of this company, and that's what when we talked about doing the hard yards or doing your work yourself, finding the truth yourself, and that's what we spend our time doing. What is the past prologue? What can this company grow at over the period of the next 5-7 years? And we want to invest in companies that can grow ultimately 10% per annum, giving us this dividend growth of 10% per annum at least. But what we also do, and that means many companies might be growing at 15, 20, 25%, whatever the number is. So when we think about our Dundas ratio, the Dundas ratio is the sustainable level of growth of the company. We will then look at, okay, what is our total return expectations for this company? And this is where we build in the valuation piece. So if a company can grow at 15% for the next 5 to 7 years, we'll also look at the dividend yield. So it may be yielding 1.3% is the dividend yield of the portfolio. So let's call that between 16 and 17% is our return expectations. At that point, we'll then look at the valuation and say, okay, does this company have a valuation headwind or tailwind over the next 5 to 7 years? And we'll factor that in. What percent per annum should we adjust our valuation? And we're looking at that and bringing it back. And as long as if for example the shares are highly rated and we expect a headwind, is there enough of a gap between this 10% dividend growth or 10% growth rate and our 17% for us to invest in that company? So we think about it as very much a case of once we've done the hard yards, what the growth rate is, we'll take the valuation into account to make sure we can still get our 10% return and 10% dividend growth per annum.
Yeah. It makes a lot of sense, David. As I said at the start of this episode, I'm thinking about dividends in a whole nother way after speaking to you. And I think that's what I love about speaking to experts. And what Bryce and I get to do is that there's so many different ways to make money in the market. There's so many different ways to approach investing. And we're pretty lucky that we just get to speak to people like you and sort of hear about them all. And this whole sift idea as well is a great one that I'm going to make Bryce start sifting through industries with me. Do you guys have a timeline for what you're going to be sifting through next? Have you got some that you want to focus on as you get to the end of 2021 and into the start of 2022?
Yeah, I mean, there's always a pipeline. We've just started, so we just finished the auto sift as we talked about, which was really what was fascinating. So we're just starting the consumer discretionary sift. So we're actually just finalising our initial, so going through from I think it's 600 or 700 names, get that down to the 40 or 50. So we're literally today we'll get that down to the 40 to 50 today, and we'll get the names out to colleagues, and we'll start the hard yards of trawling through those investor relations websites and reporting accounts of those 40 to 50 names, and then share it with the colleagues, and this collegiate information sharing, which in my 20 odd years in the industry I've never come across before. It's very, very differentiated.
I would love to be a fly on the wall. Consumer discretionary, I think, would be a fascinating one to be part of, particularly given the environment we're in at the moment. So, yeah, please do share those 40 or 50 stocks with us. Wink, wink. No, David, look, it's been an absolute pleasure having you on the show for the last week, joining us all the way from Scotland, early morning. I know it is over there. So always appreciate your time coming on. Before we close out, we do have to ask, if you had to choose out of gold or crypto as a store of value, what would it be?
Yeah, well, I'm sure you could guess. I'd be more a gold than a crypto man. And I tell you something. I don't know. The Sunday Times, I was reading articles, actually the Saturday Times yesterday, and you're always looking for things that worry you, trouble you. Retail investors, what they're up to, what's going on, and there's a headline in the Sunday Times, the Saturday Times money section, where the headline was. This chap had put 50% of his house deposit into cryptocurrency, and the headline was, "Is this wise?" And I sort of shiver went down my spine at that. And at the same time, there's a really good article from Howard Davis, who's a big hitter in the UK. So he's former Deputy Governor of the Bank of England, he's former Chairman of the Financial Services Authority, and he had a big speech on cryptocurrencies the other week, and it was just saying it serves no useful purpose to investors because it's too volatile. It's not a safe haven like gold, and it's also a leading source of fraud, financial crime. Clearly, there's the environmental part with the heavy power usage is an environmental disaster. And he basically said, if you invest in it, you put a sign above the door saying, "Abandon hope, all ye who enter here." And I must admit, I'm very much in Howard Davis's camp.
Yes. Well, yeah, well, it doesn't feel like we're any closer to a consensus on the answer to that question. So we'll continue to ask our experts and see what they say. But look, David, as I said, it's been a fascinating week. You've provided a tremendous amount of insights, and I know that our community would get a lot of value out of that, because Alec and I certainly have learned a lot. You've got us excited about dividends, but also your investing process is incredibly interesting, and one that we haven't come across or heard about before. So if anyone is interested in what you're doing at Dundas, is there a best place that we can direct our audience?
Yeah, absolutely. We'll have our own website, or if there's all sort of email addresses that you can email into the company, and we will respond to you. But go to the website first place.
I would encourage our audience to do so. And yeah, it's been an absolute pleasure. So thank you very much for sharing your time with us this week. We know you're incredibly busy sifting through the thousands of companies out there. So all the best with the consumer discretionary today, and we look forward to keeping in touch.
Great. Many thanks indeed.
And that brings us to the end of our week with David. Absolutely fascinating week, Ren.
Yeah.
I certainly learned a lot.
Can't wait until we do our first sip.
I know. But anyway, we'll be back next week, as always, with another week of Equity Mates on AusBiz. See you then.